So let's talk about financial modeling. Who's built a financial model? That is, who's built projections, balance sheet, income statement, cash flow? A good number of people. Debt schedule, linking up, doing some revolver modeling, anything like that. All right, that's basically what the exercise is going to be here today. As investment bankers, and we'll see in a moment, oftentimes projections aren't given to us by management. Oftentimes we need to build those ourselves. We need to figure out what is a reasonable set of assumptions to use. That is, what might a good growth rate be? What might profitability margins look like? How would we expect our accounts, our assets to turn over? How frequently would we turn over our assets, that type of thing. And when we combine all those assumptions together, it gives us the ability to build income statement, balance sheet, cash flow, debt schedule, etc. All right. So bankers, private equity professionals, pretty much any time there's a transaction, someone is building a model. And it's usually the analyst or the associate getting at least the first crack at building the model. But anytime we're taking a look at selling a company, there's going to be a model put in place, usually to justify valuation. If we're selling the company, we want to be able to justify the valuation to the buyer. The buyer is then going to take that model and probably make some tweaks to it and understand what that company might look like post-acquisition. All right, so sale of a company, merger of a company. If we're raising capital, we'll probably put together a model to show how that infusion of capital affects the company's balance sheet, and then how that plays out over some period through the income statement, cash flows, etc. Can the company cover its interest expense? Can it amortize its debt? What would the returns on equity be if we're raising equity for the company, that type of thing. Leveraged buyouts, we're going to spend a lot of time on that next week. We're going to actually spend the whole weekend next week talking about leveraged buyouts. So the model we build today, we're actually going to modify next week as though we were putting together a leveraged buyout of this company A. And then any restructuring or bankruptcy, to the extent a company's debt is getting restructured, the terms of that debt are getting restructured, we would want to see how that flows through the income statement on a post-restructuring basis. Again, answering the question, can the company service its debt? Can they cover their fixed operating costs? Those types of things. And again, an analyst associate typically is taking the first shot at putting together the model. A lot of times senior bankers might be giving some guidance, or the company might be giving some guidance. Or the analyst might be asking the company for guidance. What is a reasonable growth rate to use? What type of capacity does the company have? How much utilization will the company have going forward? Those types of things. But sometimes early on, let's say we go in and we're pitching, we're trying to win some business. Again, we'll talk about the pitching process in a couple weeks. But if we don't have access to management, we might have to make assumptions up on our own. Or we might have to look at equity research reports or try and find some information on the company on the internet, maybe look at credit ratings, etc., to devise a set of assumptions. All right, so those are some of the reasons we put together models. That's kind of the analyst, the associate's role in doing that. When we put together a financial model, there's a lot of different steps that we need to follow, a lot of conventions, a lot of guidelines that are useful to follow. One key step or one key tip is keep our historical information on the same page. All right, so historical balance sheet, income statement, cash flow, we'll typically spread whatever data we have or whatever data we're given, 3 to 5 years of historical results. Okay, so we'll have, and you'll see this in a moment when we open up the model and start working, we'll have 3 to 5 years of historical, and then usually it'll be separated by a dotted line, and then we'll do projections out to the right of that. All right, so we'll typically keep those on one worksheet. We'll also calculate some historical ratios and assumptions. We'll put those on a separate worksheet, usually an assumptions tab, where a lot of our assumptions are things that we hard code that drive our model. And to the extent we ever want to change the results of our model, we make changes on the assumptions tab, and it filters through to the rest of the model. Just like everything else in banking or in private equity, formatting is very important. The blue-black convention that we talked about holds here as well. Anything blue is an input, anything black is output. And typically on your assumptions tab, most of what is going to reside there will be blue. We'll be hard coding a lot of our assumptions. Most, if not everything, on our model tab will be output. All right, that is, it will be driven by our assumptions page. Clearly labeled pages. should go without saying, typically when we put together models, at some point we put them in front of the client, so the client needs to understand obviously what they're seeing. Blue, black, we talked about. Ideally, same font and letter size. That also should go without saying. Our dollar amounts, our comma, any numerical amounts, typically 1 decimal point. For percentages, 0 or 1, just kind of depending on the situation. And another thing I'll note right now is just format as we go. All right, so set print ranges, set preferences, code everything in blue or black, set up all the formatting as you go. The last thing you want to do in banking is get to the end of your model and have to go back and spend a few hours on formatting. Right? Chances are you're not going to remember everything that you did. You're not going to be able to, you're going to have to manually trace your steps, figure out what needs to be blue, what needs to be black, set your print ranges. The last thing you want to do is spend a few more hours on that at the end. Chances are you might make some mistakes. And just like we showed you in the spreading exercise, footnote or leave comments, make sure your assumptions can be traced to somewhere. All right, if we're pulling it from an outside source, cite that source. Okay, if we're combining two numbers, maybe leave a comment telling the associate or telling whoever picks up that model what we've done to get those numbers, to get to those numbers. All right, these will make a lot more sense as we get into the model. And as we talked about earlier, one of the first things we do before we start even building projections, we need to know what historicals look like. So we'll typically spread those historical financial statements into our model. Like I said earlier, usually 3 to 5 years is sufficient. Sometimes you don't have that, so you spread what you have. But typically you'll see 3 to 5 years. If we're putting together a model on a public company, then getting that information is pretty easy, right? We go to the SEC, we download their 10Ks, their 10Qs. All the information is readily available. If we're working with a private company, we're going to have to get that information typically from the company itself. All right, they won't have disclosed that to the public. They'll have to give us those financial statements. Just like any other time we're spreading, we're going to need to make adjustments for non-recurring items. Okay, so just as we did when we spread our comps, we will also make these adjustments in our, as we spread the historical results in our model. The goal being to get the company to as close to a sustainable set of numbers as possible. What would we expect this company to do from an operations perspective, absent any one-time events? And keep it simple, I think, keep it as simple as you can, I think is always good advice. Don't overcomplicate if you don't need to. All right, well, once we have the historical financials input into Excel, typically what we're going to do is calculate a lot of ratios based on those. That is, we're going to look at how quickly has the company grown its revenues historically. What has been their relationship of cost of goods sold to sales? What has been their gross margin? Because obviously going forward, if a company's grown at only 2% a year, to forecast 30 or 40% growth per year going forward might be a little bit of a stretch. Right? To forecast radical changes in their margins might be a bit of a stretch. So we use this to give a little bit of perspective as to what the company's done historically. SG&A, how much SG&A have they had relative to sales? Very importantly also, what is their operating margin? What is their EBIT margin? What is their growth rate in EBIT? Maybe what is their EBITDA margin? Growth rate in EBITDA. We'll capture a lot of those things as well. We'll look at typically what is depreciation been, either as a percentage of sales, oftentimes as a percentage of gross PP&E. Okay, sometimes we might even go so far as to put together depreciation schedules, right, taking a look at usually each piece of fixed equipment, depreciating it separately, and then tallying all the depreciation from all pieces of equipment. Tax rates. We'll talk a little bit about interest expense and interest income later. We really focus more on debt schedules when we're calculating those items. We'll get to that a little bit later. And then any other items in the income statement, right? Other income, other expense. A lot of times, anytime you see the word other in a category on a financial statement, it's usually a catch-all for a lot of smaller items that really aren't big enough to merit their own line item. But at any rate, we do want to understand what those are. We want to understand to the extent to which the company will have those items on their income statement going forward. All right, well, we do the same thing relative to the balance sheet and the cash flow statement as well. Okay, on the balance sheet, like I mentioned earlier, we're typically going to look at working capital turnover. That is, how quickly does the company collect its receivables? How quickly do they turn their inventory? How quickly do they pay their payables? Those types of things. And if they're collecting their receivables in 30 days, historically, we're probably going to want to be at least somewhat consistent with that in our projection model, in the absence of some evidence to the contrary. Same with inventory, same with payables. There might be, just like on the income statement, there might be line items categorized as other. You might have other assets, other liabilities, and again, we'll want to understand what those are. We either want to talk to the management team or read the financial statements, the notes to the financials, get a sense for what they are and what a reasonable assumption will be going forward. CapEx often captured as a percentage of sales. All right, so if we take that year's CapEx divided by sales, just like we did when we spread our comps, that's typically a methodology we'll use in forecasting projected CapEx. And then any asset dispositions. Is the company selling assets? Are they disposing of assets on a regular and frequent basis? And if they are, that's something we want to understand. We want to capture that in our projections going forward. Right, so those are a lot of the items relating to our historical financials. Once we understand those, once those have been spread, now we can actually start putting together assumptions for the future and actually putting together financial projections as well. So if we're talking about the income statement, typically on the top line for revenues, a lot of times what you'll see is, just like we did yesterday in class, just like you did for homework, we'll assume some growth rate in revenues. Revenues are going to grow 5% a year, or 10% a year, or 2% a year. Really just depends what's relevant in that case. That's about the most simplistic assumption we can make. And I mentioned it yesterday, oftentimes we might go a little bit deeper. We might say that, say for a producer of steel coils, we want to forecast, not just overall revenue growth, but how many steel coils are they going to sell? What will the pricing be for each? How will that change over time? And we're putting together a more detailed calculation of revenues. All right, we've got an example for a restaurant chain as well, really thinking about what are the key drivers of revenues and how will those change over time. All right, I actually did it was a litigation matter a few years ago. We modeled an air cargo company, and we actually modeled each plane, its utilization, its price per ton, that type of thing, the routes that it would fly, the number of miles that it would fly a year, and we modeled based on that. We did a very detailed build-up approach of revenues. So you can get pretty granular on these types of things. On cost of goods sold, a lot of times it might be just like revenue with a straightforward assumption, it could be a percentage of sales, but it could also be, obviously in the steel coil example, what is the cost per ton of those steel coils that we expect to sell? All right. And sometimes cost of goods sold might have some, not just variable costs, but also some fixed costs associated with it. All right. So no matter what the volume is, there might be some fixed costs. If that's the case, if there's a fixed variable equation, we'd want to understand that as well. Depreciation, like I said earlier, can be calculated as a percentage of gross PP&E. That's what we're going to do in our model today. But again, it can also be based on a detailed depreciation schedule. The air cargo case that I worked on, we not only modeled the revenues and the costs for each plane, we also did a detailed depreciation schedule for each plane as well, and depreciated those. We figured out when would they be purchased, over what period would they be depreciated, and we'd build up depreciation based on those schedules. Any questions so far? Really just walking down the income statement. SG&A, in our model, we're going to assume SG&A is going to be a purely variable component. It's just going to be a percentage of sales. So as sales rise, SG&A will rise. As it falls, SG&A will fall. But in reality, a lot of times you'll find that SG&A expenses may have a fixed component to them. All right, that is, the president's going to get paid their $10 million salary no matter how much the company sells. All right, so that would be more of a fixed cost, and we'd want to model that and understand that as well. Now when we get below the EBIT line, when we start talking about interest expense, interest income, these are items that we're going to calculate in a debt schedule. That is, we're going to model each individual piece of debt, figure out how much the company's borrowing or repaying, figuring out how much interest is going to be paid on each piece of debt. We'll do that in a debt schedule. We're going to get to that a little bit later. And as I said earlier, other items, we need to understand what they are, and we need to understand how those are going to play out during that forecast period. All right, so sometimes we might just assume other income, other expense might be zero. In some cases that might make sense, but at the very least we want to understand what those items are and understand what the good assumption, what the right assumption is to make. Taxes, usually we'll assume some tax rate, 35, 40%, 38%, what have you. But if a company does have net operating losses that they can carry forward to offset future taxable income, you'd want to understand that as well, understand how they intend to use those NOL carry forwards. You see that a lot with small companies that have lost money for the first few years of their existence. Once they start making money, they can offset that income with prior losses. Now on the balance sheet, if we walk straight down the balance sheet, our cash position is not really something we explicitly forecast. It's going to come out of all of our other projections combined, and it's going to be really closely related to how we model our revolving line of credit, our borrowing and repayment needs and opportunities. We'll talk about that a little more when we get into the debt schedule itself. But receivable days, or receivables inventory typically are based on assumptions of turnover. That is, how many days will the company take to collect its receivables? How many days will it take to turn over or sell its inventory? Those types of things. Other assets might be, it might just be a case where we assume zero, might be a case where we assume a percentage of revenue, really just depends on what they are. And then finally, goodwill. Remember we talked about it, I think in the first day of class, but goodwill can no longer be amortized. It's booked on the balance sheet, and then it's tested annually by the accountants to see if there need to be any impairment charges. Some intangible assets, notably financing fees these days, still can be amortized, but most other deal fees, and we'll talk more about this when we get into leverage buyouts, can no longer be amortized. PP&E, when we talk about the fixed assets of a company, this is going to relate to obviously how much the company is spending in terms of CapEx. So we take the prior year's PP&E, gross PP&E, we add CapEx to that, we subtract any asset sales that will give us this year's gross PP&E. And from that, we typically deduct accumulated depreciation, cumulative depreciation, to arrive at net PP&E. On the liability side, accounts payable, just like accounts receivable and inventory, we're going to model this based on an assumption of how quickly, how many days it takes the company to pay its vendors. All right, so we'll typically use an accounts payable activity ratio, accounts payable days, accrued liabilities and other. Sometimes these can be zero, sometimes these can be a percentage of cost of goods sold. Really just depends on the situation. All right, and then when we get into debt, again, we're going to talk a lot more about that when we get into the actual debt schedule itself. Each piece of debt gets modeled separately. And then finally, shareholders' equity. Everybody should know what retained earnings is. We take last year's retained earnings plus any net income that we've earned this period, less any dividends. It'll give us this year's retained earnings balance. And then sometimes, I don't like to see it actually, but sometimes you might see an other or some plug or balancing figure. My opinion is that when you model, you shouldn't need to plug. You shouldn't need to have a balancing figure in your model just so your balance sheet balances. And the way we teach you to do it in class here, you shouldn't need to have that. Right. That'll make sense when we actually get into the modeling a little more. But plugs are just generally something that I don't like to see. And then finally, the cash flow. Right? All changes in our balance sheet accounts need to be run through the cash flow. And that should have become a little evident last night in doing the homework for the DCF. You started to see how accounts receivable growth was a use of cash, paying down payables was a use of cash, selling inventory would be a source of cash, those types of things. Those changes tell us what's happening with our cash flow. At least what's happening with our cash flow in some respects. They need to get run through the cash flow statement. And just like we talked about in class 1, operating cash, we take net income, we add depreciation and amortization because they're non-cash items. And then we add or subtract any changes in our working capital. And then any other non-cash expenses that are in our income statement. Non-cash gains, non-cash losses, etc. Investing activities, basically our CapEx, any sales of assets, purchases or sales of long-term investments, those types of things. Cash from financing, really going to be related to our debt schedule. Changes in our debt, changes in our equity accounts, any dividends that have been paid out, those types of things. And again, ending cash is simply equal to beginning cash plus our change in cash for the year. And our change in cash for the year is just the sum of cash from operations, cash from investing, cash from financing. And then finally, the debt schedule is something else that we put together. And again, this is really geared toward analyzing each piece of debt individually, calculating how much interest expense and or potentially how much principal is being paid down on each piece. All right, so each tranche of debt will be looked at separately. They'll typically have separate interest rates associated with them. Our debt schedule is going to allow us to calculate how much interest is going to be paid on each. Okay. The one component of our debt schedule that I want to talk a little bit more about, though, is a revolver. Okay. The company, if it needs cash, we assume that it's going to have some revolving credit facility in place. It can go borrow from that. When it has excess cash, it's going to pay down its revolver. Okay, just like you or I might use a credit card. I think that's a good way to think of it. But the one thing I want to talk about now is how these financial statements, how the income statement, how the balance sheet, how the cash flow statements relate to one another. And I want to start talking about the integrated nature of these statements, and when we say integrated cash flow model, I want people to understand what I mean by that. All right, so if we take our income statement, just like we've seen several times already, revenues less cost of goods sold gives us gross profit, less SG&A gives us EBIT, less interest gives us pre-tax or earnings before tax, less taxes gives us net income. Okay, actually I want to do these in reverse order. Okay, well, where do we see then net income? Where does net income goes? As we just talked about a moment ago, it's the first line item on our cash flow statement. In our cash from operations section, we're reconciling net income to be on a cash basis. So we've got net income plus our D&A plus or minus any change in working capital. Okay, and we sum those up. That's our cash from operations. Our cash from investing, we've got CapEx. Okay, any dispositions to the extent the company has them. Cash from investing. And then our financing section will be changes in our debt accounts, changes in our equity accounts, less dividends, cash from financing. And if we add the three of these up, it gives us our change in cash for the year, right? And if we add these three together, we get our change in cash for the year. If we add that to beginning cash, we get our ending cash. Okay, well, where do we see ending cash? That goes right back to the balance sheet, right? It's the first line item on our balance sheet. It's cash, got AR, inventory, etc. Those are our current assets. Got gross PP&E, less accumulated depreciation, net PP&E. We've got goodwill, etc. We've got total assets. All right, I'm abbreviating. Okay, a lot of these individual accounts aren't that important for this example. And then on the liability side, AP, accrued liabilities, etc. Maybe current portion of long-term debt, revolver borrowings, short-term borrowings, or maybe revolver borrowings might be longer term. Really depends. All right, so you got our current liabilities, we've got our long-term debt, maybe including those notes payable. Okay, and then we've got our shareholders' equity accounts, retained earnings, common stock, etc. And I am just abbreviating here. And then total liabilities and shareholders' equity obviously have to equal total assets. All right, so that's kind of a rough outline of how the statements work together. Right? But what happens when come through our income statement, maybe the company's losing some money, roll through our cash flow statement, maybe at the end we add up our cash flow statement, we add up all our changes in cash, and it shows that the company has negative cash at the end of the year. And typically, you can't really have negative cash. Okay, what is negative cash? It means the company needs to do what? They need to borrow, probably. They need to get some capital to at least bring their cash position to zero. And typically what we do in that situation is if they've got a revolver, they're going to borrow. That is, their revolver balance is going to go up, at least to the point where we can get ending cash to a zero balance level. Right, well, what happens if a company borrows? Anytime we borrow, anytime we take out more debt, we have more interest. So interest expense goes up. All right, what happens when interest goes up? Earnings go down. Earnings go down, we need more cash. We need more cash, we look to our revolver, we borrow more debt. We borrow more debt, we have more interest. Everybody see the cycle there? That's what we mean when we say an integrated cash flow statement, or an integrated projection model. This is basically what we're building. Okay, this is what we're going to be building today. And the way we determine the amount of debt that the company needs is through that debt schedule. So that debt schedule, specifically the schedule where we figure out our revolver borrowings or repayments, ends up being the glue or the keystone to our model, in that it tells us how much cash we need to borrow or how much cash we have available to repay excess borrowings. Or maybe how much excess cash we have just to put right back on our balance sheet. Okay, if a company has no debt and they're just generating a lot of cash, they're not paying down debt, they're just keeping it on their balance sheet. All right, so this is basically what the exercise is going to be today. This is how these all relate to each other. And when we set up Excel in a certain way, Excel has the capability to basically solve this circular loop that we just explained. Let's, at this point, rather than going through this last section of the slides, what I want to do is build the model. A couple things before we get into it. The model, or the file, has 3 different tabs. The first tab is an instructions tab, which should mimic the hard copy handout I gave you. All right, so I gave you this in hard copy form, really so you're not having to flip back and forth between the tabs to see what your assumptions are. All right, the second tab is an assumptions tab. It also contains those historical ratios that we talked about a moment ago in the lecture slides. This is where we're showing what the company has done historically in terms of their revenue growth, in terms of their profitability, in terms of their balance sheet items, how quickly have they collected their receivables, turned their inventory, etc. We're also going to have some interest rate assumptions here. So what is the company going to be paying on its debt? And then also, how much is the company going to be amortizing each year on its debt? When I say amortizing as it relates to debt, I mean how much are they paying down in principal? All right. Sometimes pieces of debt will have not only the requirement to pay interest, but they'll also require the company to pay principal as well. Think of like a mortgage or a car loan that we might take out. When you make that monthly payment, usually it includes some interest, it also includes some principal. And a lot of times the same thing will hold when we talk about longer term pieces of debt like term loans, that type of thing. And then the third tab of our model, the actual model tab, this is where, as we talked about earlier, on the left side we've got historical financials of the company for the last 5 years. And you'll see that each year of our historical period has an A after it, A being for actual. All right, so we put these in really to give the reader a perspective. What has the company done historically? And then allowing them to see or to contrast that with what we're projecting. And then at the end of the day, does it make sense? Do these projections make sense based on what the company's done historically? We've also got all of our financial statements on one page or on one tab. We've got our income statement, we've got our balance sheet, we've got our cash flow, and our debt schedule. And it's generally recommended to set up your model this way as opposed to, say, putting an income statement on one tab, a balance sheet on another, a cash flow on a third tab, and a debt schedule on a fourth tab. When you're toggling back and forth between tabs, you increase the chances of making an error. And by keeping as much as possible on one tab, you're minimizing that chance. And it's also easy to scroll around and look at the output as well. All right, so that's basically how this file is set up. The first thing we're going to do, we're going to first review the instructions, and then we're going to populate these assumptions, because without the assumptions we can't build our model. We'll populate our assumptions tab, then we'll build our model using these assumptions as drivers. All right, so that's the exercise. Take us probably 2.5, maybe 3 hours to get all the way through this, but at the end of today's class, we'll have a fully working model where if we wanted to go in and say make some changes to the assumptions, say, instead of growing revenues 5%, what would the company look like if we grew them by 20%? We would be able to make that change in one place and have it flow all the way through our model. And that's one of the goals to have a working model, is to be able to sensitize it and make those changes. One thing I mentioned yesterday is as we go, I'm going to keep a running tab of the keyboard shortcuts that I'm using. When we model in Excel, it is very, very inefficient to use the mouse. Very inefficient to go and find your mouse, scroll up, try and find the icons and click and copy and paste and select ranges. It's much easier to use the keyboard. And the way Excel is set up, there are a lot of unique, helpful keyboard shortcuts that we can use to do things like copy and paste and do those repetitive items and save ourselves a tremendous amount of time. So one of the biggest goals of today's exercise, number one, I want everybody to understand what we're doing, but I want you to get away from using the mouse. All right? Try not to use the mouse at all. Try to use these keyboard shortcuts. Again, I'm going to list them all on the board. I'd recommend that you keep a running list in your notes, something that you can refer back to. We give you, as part of the course materials, we gave you rather, a large, very comprehensive list of keyboard shortcuts. It's a huge list. The ones I'm going to give you today are the ones that I use most often and I think you will use most often. All right, so keep a running list of these. Commit them to memory, and the more practice you get, the more second nature it'll become. All right. You also, if you ever go to work in an investment bank, if you get caught using the mouse, people will give you a hard time about it. All right. You shouldn't really be using a mouse when you model. All right. First thing I want to do, though, before we review these assumptions, is I want to make sure Excel is set up properly. All right. I want to make sure we configure Excel in a couple different ways. One, I want Excel to be able to take into account the circular logic that we outlined on the board earlier. Because if we don't set up Excel, you're just going to get a circular reference warning over and over and over. All right. So the first thing I want to do is I want to change some of the global settings on Excel. If you're working in Excel or in Office 2003, it means that you probably do not have this little icon up in the top left corner. Now it's hard to see on the screen. But you don't have that Office button in the top left corner. If you're working in Excel 2007, as I am, you do. All right, so if you're in Excel 2003, what I want you to do is hit Alt-T-O, Alt, Tools, Options, and you're going to get a pop-up box. In that pop-up box, I want you to select the Calculation tab. And then just wait a minute, because I'm going to get the Excel 2007 folks to the same place. If you're in Excel 2007, and here you can use the mouse. I'll let it slide this one time. I want you to click on this icon up in the upper left corner, and I want you to scroll down here as I'm doing and select Excel Options. Click on that. You'll also get a pop-up. And I want you to click on Formulas on the left side as I've just done. And now you should have a screen that looks identical to what I have on the screen here. The first thing I want to do, now regardless of whether you're in 2003 or 2007, I want you to make sure that the box next to Enable Iterative Calculation is checked. Iterative calculation means calculate something over and over. It allows for circular references to exist in an Excel model without creating an error message. So check that box, and in the maximum iterations box, I want you to put some high number, usually 500 or 1,000. That is, it tells Excel how many times to calculate that loop every time until it finds a solution that solves all the equations. I like to use 1,000. You can use 500. It's really up to you. The next thing I want to do, once we've got the iterative calculation box checked, I want to set up Excel so it only calculates when I tell it to. That is, I want to run in manual calculation mode. Okay, so under Calculation Options, I want you to check the box or highlight the little area that says Manual. And I also want you to check the box where it says Recalculate Workbook before saving. What this means, again, is that Excel is only going to calculate formulas when I tell it to do so. In a lot of cases, if you're running in automatic calculation mode, Excel will calculate every formula in a worksheet every time you step off a cell or every time you hit the Enter button. We don't want that when we model, because if we make an error, if we make a mistake, because this is an iterative loop, a lot of times those error messages will filter all the way through our model, and it will make it very difficult for us to undo them. All right? You might get errors like pound div 0 or pound ref or pound value. All right? Again, once those error messages filter through our model, it can be really tough to undo those. Running in manual calculation mode allows us an opportunity to avoid making a potentially catastrophic mistake and avoid having us needing to spend sometimes several hours debugging a model. I'm going to show you an example of that once the model's built, how you can get a pound value or a div 0 error or a ref or pound ref error in the model. But for now, let's just run in manual calculation mode, which means anytime we want Excel to calculate, we need to hit the key F9. All right. I'm going to start putting these up on the board like I said I would. So first one I'll put up is calculate F9. I'll put up a couple of the others that I used yesterday. Locking on a cell reference. Remember when we locked navigating? Remember navigating between tabs? Remember control page up, control page down. Right, again, I don't want you using the mouse, especially selecting on the tabs. You want to use control page up or down to move right or left across those tabs. If you're all set, click OK, close out of those menus, and we should get back to this Instructions tab. All right, so let's review these assumptions that we're going to use in our model. All right, these are the assumptions that we're going to hard code into our Assumptions tab. These will then drive our model. Now in the real world, chances are you're not going to get a nice, neat, and pretty assumptions sheet like this. You're going to either have to analyze the historical results of the company and figure out what you think is reasonable. You might have to talk to management. You might have to talk to senior bankers. You might have to do a combination of all three if you're building the forecast yourselves. All right, but for the purposes of class, for the purposes of homework, you'll have an instructions page, which is pretty easy to follow. So for the income statement, we're going to assume the following. We're going to assume, just like we did in the homework last night, revenue is going to grow 5% every year. And we know how to do this, so we're just going to set up a 5% revenue growth rate in our assumptions. We're going to assume the cost of goods sold is going to be 40% of revenues. 1 minus 0.4 or 40% is 60% gross margin. Depreciation as a percent of sales is going to be 2%, or I'm sorry, as a percentage of gross PP&E is going to be 2% every year. In this model, we're going to have no amortization. But when we modify this model next week for leveraged buyouts, we're going to have some financing fees that need to get amortized. So we're still going to set up the model to be able to handle amortization. We're just going to have 0 in this case. That'll make more sense when we get into it. SG&A as a percent of sales will be 30% a year. We're assuming that SG&A is purely variable. All right, again, in the real world, you're probably going to see situations where you've got some fixed SG&A, some variable. In this model, we're going to try and keep it simple. We just want you to understand mechanics. We're assuming 30%. Other income or expense is going to be 0, and we're going to assume a 40% tax rate. So those assumptions get us all the way through our income statement. And then as we had set up the model in the model tab, we're just going to work straight down. So the next statement we're going to work on is the balance sheet. And remember, I'm not going to have an explicit assumption for cash. Cash comes out of everything else that's happening in our model. It comes out of, it's the last line item on the cash flow statement becomes cash. So the first real assumption we need to make is accounts receivable. What we're going to assume is that accounts receivable will be collected in 30 days. Inventory will be turned over every 45 days. Other current assets will be $1 million. And we're going to have no amortization of goodwill. All right? And we shouldn't. We can't amortize goodwill anymore. That is, goodwill will stay flat every year in our forecast period. CapEx will be 5% of sales. We need that in the balance sheet, remember, to tell us what our gross PP&E is going to be. We can't calculate gross PP&E without knowing how much we're going to spend in CapEx. So that's why we've got that listed here. We also can't calculate it without knowing how much in asset dispositions we may have. In this case, it'll be 0. All right, but in any case, you always want to take into account asset dispositions in calculating gross PP&E. On the liability side, we're assuming the company pays its payables within 50 days. We're assuming accrued liabilities are going to be 3% of cost of goods sold. Other current liabilities will be 2% of COGS, and other liabilities, and these are other long-term liabilities, are just going to be $2 million. The equity section, common stocks, just going to stay flat at $10 million every year. We're not assuming any equity injections or equity withdrawals. Okay, and then the last few assumptions we need to make for our model, we need to understand what are the interest rates the company will be paying on its debt, and what is the amortization associated with some of their debt. On the interest rate side, we're assuming that the revolver and the term loan are going to float. They'll be floating rate debt. That is, they'll vary relative to some interest rate index. In this case, our interest rate index will be LIBOR, the London Interbank Offered Rate, and our spreads will be 200 basis points or 2% over LIBOR for the revolver, 2.5% or 250 basis points over LIBOR for the term loan. And we're assuming that LIBOR is going to increase 25 basis points every year. 25 basis points would be 0.25%. All right, basically 1/100th of a percent. Okay, interest earned on our cash, because a company, if they have excess cash, they can earn interest on that as well. Usually what a company will do is sweep its cash into an overnight account. They'll earn a little bit of extra money on that. And our interest earned on cash, that rate will also increase by 25 basis points a year. And then finally, the unsecured debt. The company's unsecured debt, their most junior debt, will have an interest rate, a fixed interest rate of 12%. So no matter what LIBOR does, no matter what any other interest rate index does, this debt will stay fixed at 12%. And then finally, our amortization. Remember, amortization means principal repayment. On the term loan, the company is going to pay down $20 million of principal per year. And on the unsecured debt, we're going to assume it's interest only. That is, there will be no pay down of principal during our forecast period. Now, down below, we've given you also a very, very detailed set of instructions for entering these assumptions into the model, and then integrating those assumptions into the model as well. All right. This is basically going to follow what we do in class. But when you get into your homework, this is always a good kind of reference to kind of have to the side if you're ever building projections, wanting to know what a step-by-step approach might look like. These can be helpful. But we're basically going to follow this detailed set of instructions as we build our model in class. All right, so I'm not going to review these line by line. We're just going to do them. All right, so those are the instructions. Next thing we need to do, we need to enter some of these assumptions into our Assumptions tab. So I'm going to Control Page Down once. Will take me to the Assumptions tab, and we're going to start entering the assumptions. Right. So let's start entering in some of our assumptions. We're going to start at the very top for revenue growth rate and just work down until we've completed all the line items on this page. Right. So revenue growth rate in 2009, we said 5%. I'm going to enter a 5 and hit enter. And you'll see that we've pre-formatted this worksheet so that when you enter 5, it comes in blue. Right. In the model tab, pretty much everything is black, so if you start entering numbers and it's coming in black, you know that you should be setting up a link. Just the same way we've set up all of our other models. All right, so we'll enter 5 in year 1. The next thing I want to do is I want to enter 5 in each of these 4 successive years, 2010, 11, 12, and 13. Now I can manually enter these, but a far quicker way, because revenue growth we're assuming to be 5% in every year, I'm going to copy. I want to copy and paste this. It's quicker than manually entering data. All right, so there's basically 3 ways to copy and paste. The first way is using the mouse, and again, that's wrong. All right, I don't want you scrolling up here, finding your copy, which I don't even think that's copy. Yeah, copy, then going down here and selecting your range, and then go back up and finding your paste button. Right? That takes a lot of time, very, very inefficient. When you have to replicate that series of actions over and over, hundreds or thousands of times, it adds tremendous amounts of time to your modeling. All right? So what I want to do, I can copy. The other 2 ways to copy are are greatly preferred. First way is to select the cell you want to copy, in this case H8, and hit Control C. So copy, Control C, and when you hit Control C, you should see it start to flash. The outlines of the cell will start to flash a little bit. To paste, you need to just select the cells, the destination cells, in this case 2010, 11, 12, 13. I want to select these, and the way I selected these is I went to 2010, or I8, I held down my Shift key and used my right arrow key until this range was highlighted. And once you've highlighted where you want the data to be copied, you can hit Control V, as in Victor, to paste. Everyone able to follow that? Okay. You can also do a cut command. What's the shortcut for cut? Yeah. We don't really need to cut anything in this model, but if you ever need to, that's one that you can use pretty often. A lot of these, I know these at least work in, not just Excel, but Word and PowerPoint as well. They work in all the Microsoft Office programs. All right. So cut, Control X, copy, Control C, paste, Control V. All right. That's one way that's acceptable to copy and paste. All right. I want to show you the other, though. What I'm going to do is I'm going to undo what I just did. Who knows the shortcut for undoing something? Control Z. So to undo something, Control Z. And just for fun, what's the shortcut for redo something? Do you know that?
So Y?
Yeah, it's Control Y. Okay, so if you want to replicate the last command you did, you would hit Control Y. Okay, not something we're going to use right away, but we'll probably use that at some point. Right, the third way to copy something across is actually using something I call a fill, that not I call, but is called a fill command. Right? And a fill command basically would work like this. If I want to copy this cell, and I want to fill that into these cells out to the right, I can use a fill command, which is a little bit quicker than using copy and paste. The way to do this is if you go to the cell that you want to copy, and you hold down Shift, you can use your right arrow key to select the range into which you want to fill those contents. Again, you've got to have that cell as part of that range on the left side. Once you've selected the entire range, you can use the command Control-R, fill right. And that's really useful. That is the quick way to copy something, either to the right. You can also fill down. So to the right, fill right is Control-R, fill down, which we'll use a little bit later, is Control-D, as in David. And that's the one, of the three that I showed you, that's probably the best one to use. Get used to using this fill command. It's quicker. Obviously, hitting Control-R is quicker than hitting Control-C, selecting where you want it to be pasted, then hitting Control-V. All about saving keystrokes, all about being more efficient. Right? Investment bankers work very long hours as it is. The more time you can save, the better it's going to be. Next item, cost of goods sold as a percent of revenue, which we said was going to be 40%. So we'll enter 40. And just like we did a second ago, we're going to fill to the right. Next item, depreciation as a percent of gross PP&E. All right, remember in the instructions page we said 2%, so I'm going to enter 2 in this cell. And we said for amortization, remember we said 0. So I'm going to enter 0 here. Now you can also copy and paste multiple cells at a time. You can also fill multiple cells at a time. All right, so rather than entering 2, then filling right, then entering 0, then filling right, I can enter 2 and 0 and fill right just once on both of them. Okay, but just like the other cases in which we use the fill right command, when we select our range, both of these cells need to be selected at the leftmost section of that range. And again, you select that range, hold down Shift, use your arrow keys to select 1 down and then 4 to the right. And then you can hit Control-R on both of those. All right. SG&A, 30%. What did we say for other income or expense? Was that 0? Yeah. 0, and then a 40% tax rate. And then we can fill all 3 of those to the right as well. All right. Let's move down to the balance sheet. First item, accounts receivable days. Remember from our assumptions we said 30. We said 45 for inventory, 1 million for current assets, 0 for other assets. CapEx is a percent of sales. I'm just going to go all the way down to common stock, and then I'm going to fill all of these across to the right. Just use a fill right command once to save myself some time. All right, so we're just going to work straight down and then copy them across. CapEx as a percent of sales was 5%. 0 for asset dispositions. 50 days payable. 3% for accrued liabilities as a percent of cost of goods sold. 2% for other current liabilities as a percent of cost of goods sold. 2 million for other liabilities. 10 million for common stock. Once you have those, select that entire range, scroll over to the right, and you can use your fill right command again. If there are no questions, we're going to keep moving on. Now we're going to enter our interest rate assumptions. Remember what we said, we have 2 pieces of debt that float in relation to LIBOR. All right, the revolver is going to be priced at 200 basis points over LIBOR, the term loan 250 basis points over LIBOR. All right, so in order to know what these interest rates are going to be, we first need to know what LIBOR is. And remember from the assumptions we said LIBOR is going to increase by 25 basis points a year. What we're going to do here is in cell H37, LIBOR for 2009, I'm going to say equals G37 plus 0.0025. You should get a result of 4.25%. Actually, before I copy this, what I want to do, this is currently formatted in blue. And the reality is this is actually a link. This is not a hard code. So we want to change the color of this to black. You can do this a couple ways. Again, you could use a mouse. I'm not going to get too worried if you use a mouse for this. All right, but you can also, to format cells, you can hit Control 1, and you'll get a pop-up. And then if you use your right arrow key, you can scroll over to the Font tab. And then you can tab all the way down until you get to Color. You can select Automatic. All right. A lot of keystrokes involved in this. This is why I wouldn't get too concerned if you wanted to use your mouse here. All right, use your mouse. The way to use the mouse here is to go up to that little icon with an A with a line under it. Select Automatic would change that to black. All right, in this case, it's kind of 6 of one, half dozen of the other, because using Control 1 to format involves a lot of tabs and keystrokes, and it's all right, well, what I want to do here is, because that involves a formula, basically taking the prior year plus 25 basis points, I can now copy this across. I don't have to enter that formula 4 more times. I'm going to use my fill right to fill that across, Control R. And when you initially do this, it's going to show you actually the wrong values. All right, because we know 4.25 plus 0.25% would be 4.5. Why are these values off? Because we're in manual mode. Excel doesn't calculate formulas until you tell it to. To get it to calculate, we want to hit F9, and then your numbers should look like this. It should range from 4.25% in year 1 to 5.25% by the end of year 5. Now we can also, because we're making the same assumption regarding our interest earned on cash, that is, the interest rate earned on cash is going to increase by 25 basis points a year, we can actually copy this formula down as well, instead of having to retype a formula and refill across to the right. If you select, or if you keep those 5 cells selected, hold down Shift, use your down arrow key once, now we can use our fill down command, Control D, F9 to recalc, and now we've got the interest rates earned on cash. All right, so that fill can be used not only to fill to the right, can also be used to fill down. In some cases you can fill to the left as well. There really aren't many cases you're going to need to do that, but I think you can. All right, well, the next item we need to do now, because we know what LIBOR is, now we can calculate what our floating interest rates are going to be. That is the interest rate on our revolver, the interest rate on our term loan. Before we do that, though, I want to point out how we've input the spread, that is the pricing spread, into the worksheet, and show you a little bit more on formatting. All right, so I've scrolled over to cell B40, B40, to the revolver, and you see that we've got that 2% plus LI in this cell. All right, this is our spread. When we say that LIBOR is going, or the revolver will be priced at 200 basis points over LIBOR, that equals 2% over LIBOR. So 2.0% plus LI represents that spread. Same thing for the term loan. In that case, it's 2.5% plus LI. But if we look in the formula bar up here, we don't see anything about plus LI. All we see is 2%. So what's going on here? Why do we have 2% there and 2% plus LI down below? Can anybody tell me? Basically what we've done is we've used a custom format. Okay, we've used a custom format to specify that whatever we type in that cell, whether it's 2% or 5%, add on to that the text plus LI. Right? And if we go to Control 1, if we go to Format again, go back to the Number tab, you don't have to do this on yours. I just want to show you where you would go to create or use a custom format. If you go to that Format and then the Number tab, you'll see that we have Custom highlighted. So we're using a custom format, and we've selected the format, enter in some numerical value as a percentage plus LI. You can create, you can change custom formats however you'd like. If you wanted to change this, maybe say plus LA, plus LO, plus whatever, you can go into that line item where it says type, and you can alter what that custom format is going to look like. Create something that maybe you want to use later on, create something that you're going to use in another spreadsheet sometime down the road. But that's how a custom format is created. And then to select that, you would select custom, and then you'd have a list of all your custom formats. Now, calculating the interest rate is very simple. Basically, what we're going to do each year is we're going to take that year's LIBOR plus our spread. We'll do the same in year 2, 3, 4, 5. We'll do the same for the term loan because that also floats over LIBOR. So for year 1, the revolver, I want to say equals H37. And when I say H37, it doesn't mean you need to type in H37. The easier way is usually to scroll up and select it with your arrow keys. Equals H37 plus B40. Right, but just like yesterday, before you hit enter, think for a second. We want to copy this across. And if I were to copy this across the way it's currently entered into this cell, in year 2, it would say equals I37 plus C40. And C40 is not the right cell. I need to lock on that reference to B40. Just like I did yesterday, we lock by using F4. And now when I copy that across, no matter where I copy this in my worksheet, it's going to refer to 3 cells up, but always refer to this cell. All right, so we've permanently locked on that cell. We should have 6.25 in year 1, 6.25%. Now let's fill that to the right. Hit F9 to recalc. And I want to make sure everybody got the right numbers. So it should be 6.25 in year 1, going to 7.25 in year 5. Right? If you get 11.25 in year 5, it means you probably forgot to lock on B40. Right? But check your numbers. Does everybody have these numbers after you've hit F9? Term loan, basically the same methodology. Equals H37 plus our spread, which is B41 in this case. We want to lock on B41. And then we're going to fill that to the right, F9 to recalc. And every year, your term loan should be priced at 50 basis points above your LIBOR because it's got a 50 basis point higher spread. The last item we need is our unsecured debt. And remember back to the assumptions page or our instructions page, our unsecured debt does not float, it's simply fixed. It's going to be fixed at 12%. Out here in these 5 periods, rather than entering 12 as a hard code, what I want to do is link over to here and hit F4 to lock, and then we'll fill that across to the right. Okay, you could also link to the prior year. You could also copy one of these across. All right, if you were to copy this one across, you'd probably run into a problem when you pasted it, because it's got that border on the right side of the cell. I'm going to show you how to deal with that in a minute. Right. But best thing to do, just link over to cell B42, which is that interest rate, lock on that, and then fill that across to the right. And you should have 12% every year. Then the last thing we need to do on our instructions tab, or assumptions tab, and then we're going to take a break, we need to specify our amortization on our term loan and our unsecured debt. Okay, a revolver is not typically amortizing debt. A revolver, like we said earlier, credit card for a company, we pay it down, we borrow it as we need it or as we've got the capacity to repay. All right, so those principal payments are based on our availability of cash There's no amortization. Term loan, we said we're going to amortize $20 million a year, and the unsecured debt is interest only. So we'll enter 20, we'll enter 0, and then we can fill those both across to the right.